Understanding financial markets is, well, a complex endeavor. Many traders are on a quest, seeking tools and techniques to gain an edge. You see, price charts, they tell a story of buying and selling pressures, but, price alone may not reveal the full picture. Traders need to look deeper into market dynamics. This involves studying the forces that drive price movements. One crucial aspect is understanding market momentum. Another is recognizing when momentum and price tell different stories, a concept known as divergence. This essay will explore these important concepts. We aim to simplify these ideas for easier comprehension. The journey into technical analysis often begins with price patterns. These patterns, like head and shoulders or triangles, offer visual cues, yet the market is more than just static shapes on a chart. It is a dynamic environment, constantly shifting and evolving. The forces of supply and demand are always at play. These forces create trends, and understanding the strength behind these trends is vital. This is where the study of momentum becomes indispensable. Momentum helps us gauge the conviction of buyers or sellers. It provides insights that static price levels might obscure. Furthermore, indicators have been developed to quantify these market dynamics. The Relative Strength Index, or RSI, is one such popular tool. It helps traders visualize momentum and potential turning points. However, like any tool, its effectiveness depends on correct application. Traditional interpretations often fall short of capturing the market's true complexity. Simplistic signals like overbought or oversold can be misleading. A more nuanced approach is necessary for robust market analysis. This involves looking beyond single indicators. This exploration will delve into the relationship between price, momentum, and divergence. We will examine how indicators such as the RSI can assist traders. We will also highlight the common pitfalls of their traditional use. Importantly, we will discuss the need to integrate other analytical dimensions. These include understanding market structure through fractal analysis. It also involves grasping the overarching market flows. Ultimately, a comprehensive understanding requires a multi-layered perspective. This perspective combines various tools and concepts for a clearer market view. Market momentum is often described as, well, an invisible force. It is the power or speed behind price movements. Think of it like a car accelerating. A car gaining speed has strong momentum. Similarly, a market with rising prices and strong momentum shows robust buying interest. Conversely, if prices are falling rapidly with strong momentum, selling pressure is dominant. Momentum gives us a sense of the conviction behind a trend. It tells us how enthusiastic buyers or sellers are. This insight is crucial for making informed trading decisions. Understanding momentum helps traders assess the health of a trend. A trend accompanied by strong momentum is more likely to continue. If a price trend is occurring but momentum is weak or declining, it can be a warning sign. This might indicate that the trend is losing its underlying strength. The invisible force is fading, and the trend could be nearing exhaustion. Therefore, momentum is not just about the direction of price. It is about the sustainability and strength of that direction. Traders constantly try to measure this elusive yet critical market characteristic. Momentum can be observed in various ways. Sometimes it is visible in the steepness of a price trend. A sharp, almost vertical price rise often indicates strong upward momentum. However, visual inspection alone can be subjective. For more objective analysis, traders use momentum indicators. These mathematical tools calculate momentum based on price and sometimes volume data. They provide a graphical representation, making it easier to see changes in market strength. These indicators act as a kind of speedometer for the market. Consider a stock price that has been rising steadily. If the rate of this rise begins to slow down, even if the price is still increasing, momentum is waning. This deceleration is an important piece of information. It suggests that the buying pressure is diminishing. The unseen driver, momentum, is easing off the accelerator. This does not automatically mean the price will reverse. However, it does signal a change in market conditions. It alerts the trader to be more cautious and look for other confirming signals. Divergence is a key concept in technical analysis. It occurs when price action and a momentum indicator tell different stories. Imagine the price of an asset making a new high. Simultaneously, a momentum indicator fails to make a new high. This is a classic example of bearish divergence. It suggests that the upward momentum is weakening despite the new price high. This disagreement or divergence can be a powerful signal. It often precedes a potential change in the current price trend. The core idea behind divergence is that momentum often leads price. Before a price trend reverses, the underlying momentum usually slows down first. Divergence captures this subtle shift. It is like a warning light on a car's dashboard. The car might still be moving forward, but the light indicates a potential problem with the engine. Similarly, in markets, price might still be trending, but divergence suggests the trend's engine is losing power. This early warning can be invaluable for traders. There are two primary types of divergence: regular or classic, and hidden. Regular divergence typically signals a potential trend reversal. Hidden divergence, on the other hand, often suggests a trend continuation. We will explore these types in more detail later. For now, the important point is that divergence highlights a conflict. It is a conflict between what the price is doing and what the underlying strength suggests. This conflict is where trading opportunities or warnings often arise. Identifying divergence requires comparing price action with a momentum indicator. Common indicators used for this purpose include the relative strength index, moving average convergence divergence, and stochastic oscillator. When price makes higher highs, the indicator should ideally also make higher highs in an uptrend. If it doesn't, divergence is present. Conversely, in a downtrend, if price makes lower lows but the indicator makes higher lows, bullish divergence is present. This signals weakening selling pressure. The Relative Strength Index, or RSI, is a very popular momentum oscillator. It was developed by J. Wells Wilder. The RSI measures the speed and change of price movements. It oscillates between 0 and 100. The primary purpose of the RSI is to identify the strength or weakness of a price trend. It also helps in spotting potential reversal points. The RSI compares the magnitude of recent gains to recent losses. This comparison is then converted into a number between 0 and 100. The RSI is typically calculated over a specific period, often 14 periods. This period can be 14 days for daily charts, 14 hours for hourly charts, and so on. When the average gains are larger than the average losses during that period, the RSI rises. This indicates increasing bullish momentum. Conversely, if average losses are greater than average gains, the RSI falls. This signifies increasing bearish momentum. The RSI line is then plotted below the price chart. Traders watch this line for clues about market strength. One common way traders use the RSI is to look for divergence, as discussed earlier. When the RSI diverges from price action, it can be a strong signal. For example, if a stock price reaches a new high but the RSI makes a lower high, this is bearish divergence. It suggests that the buying momentum is not as strong as it was during the previous price peak. This could indicate that the uptrend is losing steam. Such signals are often used by traders to anticipate potential trend changes or corrections. The RSI also helps in visualizing momentum more clearly than just looking at price. A rising RSI generally indicates strengthening upward momentum. A falling RSI suggests strengthening downward momentum. The steepness of the RSI's slope can also provide information. A sharply rising RSI points to very strong buying pressure. A gradually rising RSI indicates more moderate buying interest. Therefore, the RSI offers a quantifiable measure of momentum. It provides a more objective way to assess the market's internal strength. Section 5. Beyond Overbought, Oversold, Rethinking RSI. Traditional interpretations of the RSI often focus on overbought and oversold levels. Typically, an RSI value above 70 is considered overbought. An RSI value below 30 is considered oversold. The idea is that if an asset is overbought, it is due for a price decline. If it is oversold, it is due for a price rally. However, this interpretation can be highly misleading and is a significant limitation. Markets can remain in an overbought condition for extended periods during strong uptrends. Similarly, they can stay oversold for long durations in powerful downtrends. Relying solely on these fixed levels for trading signals is flawed. For instance, during a robust bull market, the RSI might frequently enter the 70 to 100 zone. Selling simply because the RSI is above 70 could mean exiting a profitable trend too early. The asset might continue to rally significantly. The overbought signal in this context is not a reliable sell signal. It merely indicates that there has been strong upward price movement recently. This strength can persist much longer than the traditional interpretation suggests. The market is showing strength, not necessarily imminent reversal. Similarly, in a strong bear market, the RSI can dip below 30 and stay there. Buying based on an oversold RSI reading in such a market can lead to substantial losses. The asset might continue its downward trajectory. The oversold condition simply reflects strong selling pressure. This pressure can continue to drive prices lower. Therefore, these overbought and oversold levels are not absolute boundaries. They should be seen more as indicators of current momentum intensity rather than definitive reversal signals. Market context is crucial here. A more effective way to use the RSI involves looking for divergence. It also involves understanding its behavior within the context of the prevailing trend. Instead of fixed levels, some traders look for the RSI to reach extreme levels relative to its recent history. Others focus on how the RSI interacts with its own trend lines or moving averages. The key is to move beyond the simplistic overbought, oversold paradigm. Traders need a more nuanced understanding of what the RSI is truly indicating about market momentum and its relationship with price. This requires a more sophisticated approach. Section 6. Types of divergence, spotting potential reversals. As mentioned earlier, regular divergence, also known as classic divergence, often signals a potential trend reversal. There are two types of regular divergence, bullish and bearish. Regular bullish divergence occurs during a downtrend. It happens when the price makes a new lower low, but the momentum indicator, like the RSI, makes a higher low. This suggests that the selling momentum is weakening. Even though prices are falling to new depths, the force behind the selling is diminishing. This can be an early warning that the downtrend might be losing steam and could reverse. For example, consider the price of a currency pair like EUR/USD in a downtrend. If EUR/USD prints a low of 1.0500 and then later drops to a new low of 1.0450, during this time, if the RSI formed a low when price was at 1.0500 and then formed a higher low when price reached 1.0450, this would be regular bullish divergence. This divergence hints that sellers are becoming less aggressive despite the new price low. It is a signal for traders to watch for a potential bottom and a possible upward reversal in price. Regular bearish divergence occurs during an uptrend. It forms when the price makes a new higher high, but the momentum indicator makes a lower high. This indicates that the buying momentum is fading. Although the price is pushing to new heights, the underlying strength of the buyers is not confirming this new high. This suggests that the uptrend may be running out of energy. It could be vulnerable to a pullback or a complete reversal to the downside. This is a warning sign for those holding long positions. Imagine a stock, say Apple, is in a strong uptrend. It makes a high at $180 and the RSI also peaks. Later, the stock price rallies further to $185, a new high. However, at this new price high, the RSI makes a peak that is lower than its previous peak at $180. This is regular bearish divergence. It suggests that the enthusiasm of buyers is waning even as the price sets a new record. This could be an early indication that the uptrend is nearing its end and a downward move might follow. Section 7. Hidden divergence. Clues for trend continuation. While regular divergence signals potential trend reversals, hidden divergence suggests trend continuation. This makes it a very useful tool for traders looking to enter an existing trend. Like regular divergence, hidden divergence also has bullish and bearish forms. Hidden bullish divergence occurs during an uptrend. It is identified when the price makes a higher low, but the momentum indicator, like RSI, makes a lower low. This pattern indicates that despite a temporary pullback in momentum, the overall uptrend is likely to resume. Consider a market that is generally moving upwards. Price makes a low, then rallies, and then pulls back to form a higher low. This higher low in price is a sign of underlying strength. If, during this pullback, the RSI makes a lower low compared to its low during the previous price low, this is hidden bullish divergence. It suggests that the recent dip in price was a buying opportunity within the larger uptrend. The momentum indicator's lower low shows a washout of weak hands, often setting the stage for the next leg up. This is a signal to look for buy entries. Hidden bearish divergence occurs during a downtrend. It forms when the price makes a lower high, but the momentum indicator makes a higher high. This pattern suggests that despite a temporary rally in momentum, the overall downtrend is likely to continue. The lower high in price confirms that sellers are still in control at key resistance levels. The indicator's higher high during this corrective rally can be deceptive if viewed in isolation. However, when combined with the price action, it signals a potential selling opportunity. For instance, imagine a commodity like crude oil is in a downtrend. Price makes a high, then falls, and subsequently rallies to form a lower high. This lower high in price indicates that selling pressure is still present. If, during this corrective rally, the RSI makes a higher high compared to its high during the previous price high, this is hidden bearish divergence. It implies that the recent rally was likely a temporary bounce within the larger downtrend. The trend is likely to resume its downward course. This is a signal to consider short positions. Section 8. The bigger picture, integrating fractals and market flows. While indicators like the RSI and concepts like divergence are valuable, they should not be used in isolation. A more comprehensive market analysis requires integrating other perspectives. Understanding market structure through fractal analysis is one such crucial element. Markets exhibit fractal patterns, meaning similar patterns repeat across different time frames. A trend on a daily chart is composed of smaller trends and consolidations on hourly charts. Recognizing these self-similar patterns helps in identifying key support and resistance levels. It also aids in understanding the current phase of the market within a larger context. Fractal analysis allows traders to see the market as a nested structure. For example, a significant high on a weekly chart will often coincide with specific patterns on daily and hourly charts leading up to it. By analyzing these multiple time frames, traders can gain a deeper understanding of price action. This helps in filtering out false signals from indicators. A divergence signal might appear strong on a 15-minute chart. However, if it contradicts the dominant trend and structure on a 4-hour or daily chart, it might be less reliable. Context is always key. Understanding market flows is another critical component. This involves recognizing where large institutional money is likely moving. Capital flows between asset classes, sectors, and currencies influence price trends significantly. For instance, a risk-on environment might see money flowing into equities and away from safe haven assets like gold or bonds. Conversely, a risk-off sentiment can reverse these flows. Awareness of these broader capital movements can provide a valuable backdrop for interpreting technical signals. It helps in aligning trades with the dominant underlying forces. Therefore, a robust trading approach combines various tools. It uses price action analysis, momentum indicators like the RSI, divergence signals, fractal market structure, and an understanding of market flows. No single tool provides all the answers. Each offers a piece of the puzzle. By putting these pieces together, traders can build a more complete and reliable picture of market conditions. This holistic view increases the probability of making sound trading decisions. It moves analysis from simple signal following to a deeper comprehension of market behavior. Section 9. Conclusion. A holistic approach to trading success. In conclusion, cracking the market's code is an ongoing pursuit. It requires more than just learning a few patterns or indicator settings. The relationship between price action, market momentum, and divergence is intricate. Momentum, the unseen force, provides clues about the strength and sustainability of trends. Divergence, the disagreement between price and momentum, can signal potential turning points or continuations. Tools like the Relative Strength Index help visualize these dynamics. They offer a quantifiable way to assess market conditions and potential shifts in power. However, it is crucial to move beyond simplistic interpretations. The traditional overbought and oversold RSI levels are often misleading in strongly trending markets. A nuanced understanding of divergence, distinguishing between regular and hidden types, provides more actionable insights. Regular divergence can warn of impending reversals. Hidden divergence can highlight opportunities to join an existing trend. These signals become even more powerful when analyzed within the correct market context. This context involves looking at the bigger picture. Integrating fractal analysis helps in understanding market structure across multiple timeframes. It reveals how patterns nest within each other, providing a clearer view of support, resistance, and trend development. Furthermore, being aware of broader market flows, the movement of capital between different assets and sectors, adds another layer of understanding. This macroeconomic awareness can help confirm or question signals derived from purely technical tools. It ensures that trading decisions are aligned with larger prevailing forces rather than isolated chart events. Ultimately, successful market analysis and trading demand a complex, multi-layered approach. There are no shortcuts or magic formulas. It involves a continuous process of learning, observation, and adaptation. By combining the study of price, momentum, divergence, RSI, fractal geometry, and market flows, traders can develop a more robust and comprehensive framework. This holistic perspective is essential for navigating the complexities of the financial markets. It empowers traders to make more informed decisions and improve their chances of long-term success. If you found this video helpful, make sure to subscribe to the channel for more professional trading tutorials and market analysis. Got questions or topics you want us to cover? Drop your requests in the comments below. We love hearing from you. Thanks for watching, and until next time, trade smart and stay profitable.